Definitely more volatility in fixed income markets. And to, reset that range or put it into context, we entered the conflict at the end of February with yields really at the lower end of that range. As you said, we had pushed down below 4% on that guiding star for us long-term fixed income managers, the 10-year rate. And I think we entered the conflict a little bit low. That was a rate that priced in significant movement from the Federal Reserve, likely on the heels of Kevin Warsh being nominated as the new head. And then we got into a more reasonable trading range. But what we saw, particularly yesterday and through this week, is a significant repricing of expectations of what the Federal Reserve can do or what they will do at the front end of the curve. So tens pushing a little bit higher, but really that 2-year rate going even higher than that and flattening yield curves. So here we see the bond market fighting off its eternal foe, inflation. And it's a good time for investors to look more to coupon clipping or income rather than the price appreciation or diversification of the bond market.
Karen, you mentioned the Fed. I mean, the composition of it continues, of course, to be interesting. Is your house view still for one ease this year? Has that changed?
It hasn't changed. Well, moderated since the beginning of the year. We went into the beginning of the year looking for maybe two cuts expected, maybe one in June, then one in September through December, with the behavior of the markets. And some of that is health, Lisa. It is a relatively resilient and stable economy. I describe it as equilibrium. Equilibrium is not necessarily comfortable, but now with inflation coming back in, with the spike in oil prices, extreme sensitivity around the length of this conflict, we are now expecting one, and perhaps that would be later in the year. So you hear that hedging in my voice and in that position. It's a little bit wait and see.
High yield market. What's your view there? Do you have credit concerns there in the high yield market, or do you feel like the risk reward is worth it here?
I would say the latter, Paul. It's not so much, I'll recharacterize it. We're more sensitive to valuation with high yield still. We have seen a nice orderly widening of spreads there, but we are not at our target to lift out of the underweight position where we've been. We would like to see spreads closer to 400 basis points on a pretty stabilized point, not just a flash in the pan. We are above 300, but still waiting to see more value there. The companies are largely doing fine. They would not have the ability to move out of non-investment grade to investment grade. The pricing power isn't there. The ability to grow volumes, they can't correct what made them non-investment grade. Our analysts there think results are largely fine to inline, nothing to make them overly worried, but nothing to make them overly excited that they can, eclipse that non-investment grade rating.
Karen, I'm looking through your notes here. You talk about private credit being in the headlines, of course. Does it have the characteristics to build toward this systemic crisis that we've been hearing?
We don't think so. And we took a look at what has caused systemic crisis in the past. And oftentimes, yes, you do see an increase in defaults. And we look at defaults by number and also by dollar amount. But you really need leverage in the system in order to become a systemic event like long-term capital management, the late 80s, or the great financial crisis. But we all know that there's a lot of market value and road between systemic crisis and optimal markets. And I think what we're really seeing, and as many of your speakers have said over the morning, is a recalibration of liquidity and pricing around liquidity. These are loans to middle market companies that are very necessary. And we're getting a lot of our information from Bloomberg on these private markets and from media. Roger Ferguson wrote a great piece in the Financial Times where he characterized these loans and how private credit came about. But what happened as with the success of private credit, with the attractive yields, it began to be sold down into retail channels. The retail vehicles provide for greater liquidity or faster liquidity than the tenor of the underlying loans. Those are mostly 3 to 5 years. So when you have a liquidity mismatch and then you have something in the headlines that was sold for being attractive and something that you needed to have in the portfolio, and then you're seeing in the headlines that you need to get out, you're just having a mismatch in the vehicle versus the purchaser.
Karen, my good friends on the debt capital markets desks across Wall Street are having a heck of a year here. The supply's been really, really heavy. How's the market been receiving this supply?
It's been received extraordinarily well. We went into the year knowing that we would see significant new supply from merger and activity funding, and then that we would also see the hyperscalers coming to the market. They've already done more than half of their expected supply, but the supply is coming in, and because the yield and the income, it's that known variable, are attractive, it seems that investors are flocking to investment grade corporate bonds for that known income, that little bit of spread over the US Treasury, and enjoying that rather than taking excessive duration risk. So we've seen, again, a little bit of widening. We've gone out from the high 70s for the investment grade OAS until now we're into the mid 90s or so. But we see that as a restoration of value in a time where security selection can begin to matter. So one of our big themes in-house is, while we have a top-down framework, we are bottom-up fundamental reviewers of credit day in, day out. We speak to discernment and discipline around valuation. Of course, we're cognizant of themes, but as we say in-house, it wasn't likely that all software companies were great going into the beginning of this year, and it's similarly just as likely that they are not all going to fail just because the tide has turned.